Well, good morning, everyone, and welcome to the 2018 Precious Metals Price Forecast. Today we are joined by Jon Spall, Senior Advisor to the LBMA, as well as GQ Metals. He's hosting a debate between Kendall of ICBC Standard Bank, as well as Rhona O'Connell from GFMS. GFMS came second in the gold forecast last year, and Tom won for silver. So thanks very much for joining us this morning.
Pleasure. Thank you.
Indeed. I think with that, I'll hand it over to Jon to get us going.
Thank you very much indeed, Ruth. Well, as Ruth said, we're joined by Rhona and Tom, and we're going to be posing some questions to them this morning about the outlook for the precious metal complex during 2018. First of all, I'd like to ask you both, and maybe if I start with you, Rhona, what do you think is likely the most predominant factor impacting precious metals prices this year?
There's going to be different factors according to which metals you're looking at.
Maybe we should start with gold then.
Okay, kick off with gold. Risk as a generic term, but within that you can strip it out in the sense of risk to currencies, because we are expecting to see the dollar come under some weakness by virtue of conflict within the different political and financial sectors, but we can come back to that at a later stage. Silver, by its very nature, is most likely to be predicated on what gold does. Platinum has got problems both on the supply side and the demand side from its industrial standpoint. Palladium will continue to benefit from platinum's problems in the perceived problems in the diesel sector, but we do actually think that Palladium will peak this year.
Okay, thank you for that. And Tom, if I can ask you the same thing, what do you think is likely to predominate?
For me, for gold, it's really two things. It's the global economy, which seems to be entering this synchronized phase of increasing momentum and growth in developed markets and emerging markets, which we haven't seen for many years, and it's whether that is based on anything solid or the continuation of extraordinary support from central banks and policymakers. And within that particularly, we always look very closely at the US economy and how the Federal Reserve reacts to that. And with a change in the Fed governor approaching, I think it's going to be very, very interesting to see how the messaging coming out of the US Federal Reserve shifts this year, and that's going to be influential.
In fact, actually, on that basis, we saw Mr. Mnuchin talk about a weaker dollar, although that has been slightly ameliorated by comments from the administration. Do you think the weak dollar is going to prove to be crucial on that basis for gold in particular this year?
I think in two respects, is clearly important, but we have to ask ourselves, why would the dollar weaken? And I think for it to be a very bullish scenario for gold, you need the dollar to be weakening, because reserve asset managers, institutional money managers are feeling uncomfortable about the solidity of the US. They're feeling uncomfortable about the US Treasury market. If that's the rationale for people trying to reweight their portfolios away from dollar, then I think it gets quite bullish for gold. If it's simply a facet of global trade flows and interest rate differentials, it's harder to make that direct link into a bullish case for gold.
Okay. And in fact, actually, Rhona, keeping with the US administration and their likely impact on the precious metal markets, what do you think the effect of the new US corporate tax regime will have on precious metals?
You can actually argue this one both ways. I think it's probably more bullish for gold than it is bearish. The argument that it will be bearish would be revolving around the concept of greater corporate stability feeding through into dividends, feeding through into a greater feeling of comfort amongst the populace as a whole, which therefore mitigates or militates against risk hedging. On the other side of the coin, which my personal view is the more likely way that things will play out, is that you have essentially a political policy in conflict with the Fed's policy, and at some point something will have to give between those two.
Fair enough. Obviously, a lot of these conversations tend to focus on gold that we have, but just to get away from gold for a minute or two, if I can ask you first, Rhona, what do you think, or which metal do you think is likely to be the best performing of the complex in 2018?
Although I've already said we think it's going to peak, and although it's already had a most tremendous run, we still think that palladium's got more upside this year. If you take it on an average-to-average basis, we're looking at an increment of something of the order of 29%, whereas gold and platinum probably be in single figures. And as I said earlier, because of the gearing effect with silver's relationship to gold, you expect silver to outperform gold, but not by much.
Thank you. And if I could ask you, Tom, the same, which metal do you favour?
Well, for almost 3 or 4 years now, you've kind of looking at platinum at the beginning of the year and wondering if it's time to make a contrarian call on platinum. Unfortunately, I still don't see the argument there from a fundamental perspective as to why platinum should outperform. So I think, for me, the supply-demand dynamics and the drawdown of inventory in palladium does suggest that is going to have another good year in 2018. So I would concur with that view.
It's interesting. I mean, I've been in the market long enough to remember when platinum was always at a premium to gold. And certainly gold was at a premium to palladium. We've now seen platinum trade above palladium trade above platinum. Could we see palladium outperform gold in 2018? What do you think, Tom?
I don't see any reason fundamentally why not. The markets get very trapped into perceived truisms, and exactly that gold should trade at a discount to platinum, or the other way around. Platinum should trade at a premium to gold because it was more rare, pure, and eternal, as the marketing strapline was. It worked for a while, but there was no fundamental basis why that should continue indefinitely. You saw, even when that ratio reversed, there are quite a few people who expected it to last for a very short time and us to mean revert, and it clearly hasn't. So I don't think these relationships and ratios, although they're meaningful, I don't think we can look forward and project them into the future ad infinitum. You have to look at the metals on their own basis, and I don't see any reason why palladium couldn't outperform gold this year.
Fair enough. And actually, Rhona, picking up on that is true. We do tend to get ourselves, or I can be in a mindset that you remember back to the past and how it, quote, should be. But do you think palladium could outperform gold and be higher than gold this year?
I'm not convinced that it would necessarily take itself into a premium over gold. But certainly in terms of the relative performance of the two, yes, it still does have the fundamentals. As Tom says, there's drawdown inventories. A lot of that metal is tightly held. One thing I think is for sure is that we'll see bouts of volatility the same as we did last year. It's still in a backwardation, and I can't see any reason why it should come out of it.
For years, we used to talk about the impact of Russian, in particular, stocks that were thought to be keeping the market within a range. It was always a fear, if that's the right word, of keeping a lid on palladium prices. Do you think there is any sort of notion that there are? You mentioned stocks being tightly held, but you don't think there is a danger that the market could get flooded from some unknown source at some point?
No.
Tom? I mean, that's short and sweet, Rhona.
Well, I think on the inventories and stocks question, I think the behaviour of ETFs is quite interesting. When these vehicles were established, certainly for the PGMs, they were generally welcomed by producers because it was seen that these would act as a source of supply to the market when industrial demand was outstripping mine supply, and would serve to dampen price appreciation and volatility. Now palladium is getting to the point at which we've seen maybe 1.5 million ounces of metal come out of ETFs over the last 2 years. It won't be too long before we're getting to the point at which you start to question how much more metal can come out of ETFs, and then you really need to think about where the alternative source of stock that could be released back to the market comes from. And if there isn't a natural one, then you're going to see a reaction in the price.
I suppose the ongoing debate, I mean, particularly as we have it in this country with diesel as against petrol and so on, and that's clearly not going to help the argument either.
No, and the recent headlines just this week about some testing that seems to have occurred in Germany on emissions doesn't seem to be helpful to the diesel argument, and so to me the only question is about how quickly diesel loses market share. it's not even a question of if that decline in market share can be stemmed. I think the debate is about whether we see diesel as taking 30% of EU sales in 3 years' time or 20%.
Right.
That kind of conversation.
Yeah. Down from what, 50 odd?
Down from 50 plus just 3 or 4 years ago.
Rhona, one metal that we haven't mentioned is that old favourite of silver. Now, I always find gold, we can talk about geopolitics, the US monetary policy, you talked about tax before, platinum and palladium, we can talk about diesel and petrol and stocks and everything. Silver, as much as people tell me there is a shortage of silver, I never believe it. I can't really see the industrial attraction of silver. What do you think is going to impact silver and where is it going to go this year?
Oh, what a wonderful question. I've been saying for donkey's years that I love analysing the silver market. I'm only too pleased I don't have to trade it. It's an interesting animal, silver. Actually, palladium's not dissimilar in the sense that a high proportion of production is non-price elastic because it's byproduct.
Right.
In the primary sense. There is a price elasticity in scrap return, but not much because most of it's a function of past industrial activity. The market is running in a surplus, but not a huge amount, and therefore it doesn't really have any, from a classical analytical standpoint, it doesn't have any natural market clearing price, either from the supply side or the demand side, except in times of extreme. So it is, to a large extent, a gold story. I would cover myself though, because it's a paranoid metal, that one. Sometimes it thinks it's an industrial metal, and sometimes it thinks it's a precious. So there have been times when silver has been more closely related to copper, which talks to the argument that Tom was outlining earlier about economic lockstep, which supports the industrial demand side. But from the point of view of the price dynamics, pure and simple, it's more likely to remain allied to gold, which is why I think it'll probably be an outperformer, but not by very much. Right.
And for you, Tom, the same question. I mean, to preface this slightly, I've always been a firm believer that silver should trade $5 or lower, and a lot of people seem to think it should be 50 or higher. I mean 50, 50, not 15. It's a metal that divides opinion, perhaps like no other. The ICBC standard numbers are very much, we're at 1735 roughly today. You see it between 1560 and 1920 this year. What do you think could shake it out of that, perhaps?
It is, to me, silver. It's almost as much a kind of a belief system as a commodity.
Religion, yeah.
Yeah. And when you work for an institution that is a vault manager for precious metals, and you have a feeling for just how much silver there is held, not just in our facilities but globally, then clearly we're not talking about a normal supply-demand relationship. I think the broader commodity cycle is going to be influential. You do see increasing media coverage of the commodity cycle. I think we're 2 years into it now. For me, the bottom of the cycle was 2015, and as Rhona rightly says, sometimes silver reacts very well to those kind of industrial factors, not because its own supply demand is tightening up, but because it trades alongside things like copper. But I struggle to create a scenario where silver will consistently outperform any of the other metals this year. I think that would require quite a lot of upset in the global financial markets.
And in fact, actually, if I could just take that same question beyond silver to the rest of the metals, because in fact, generally the forecasts that ICBC Standard have given us have tended to be steady as she goes, basically across the metals. What do you think shakes up the system as a whole? What do you think means we could see fresh highs, or at least outside on gold you've got 1230 to 1375 for an average of 1312.5.
Yep.
What do you think could shake us out of those?
I think it does very much come down to institutional money getting uncomfortable with the length of this cycle and getting nervous about rising interest rates and the withdrawal of liquidity and what that does to other asset classes. This kind of Goldilocks global economic cycle that we have been in for 2 or 3 years now, where you've had very low interest rates, low but stable inflation, and other asset classes like equities performing very, very well. The number of warning notes, articles, signs from money managers themselves is increasing and will continue to increase. It's been a very expensive proposition to go against that herd up until this point, but I think if we do see the Fed put up rates 75 basis points over the course of this year, which is the message that is still coming out of New York, then I think that does start to create some volatility in things like equity markets, and it's in that environment that you can start to see significant moves in capital, which would support gold as a defensive asset.
So in fact, the rising interest rates, one would normally say, would be bad for gold. Do you think in the current environment, if I've understood you correctly, it could actually be a gold positive because the money needs to go somewhere? If it comes out of equities, and gold could be the recipient rather than normally it would be a victim of higher rates.
Exactly, because this hasn't been a normal interest rate cycle that has solely responded to a classic economic recession. This has been an extraordinary economic cycle. It's been a very unusual interest rate cycle, which has had multiple effects. One being that this period of economic growth has already persisted longer than the average, certainly for the US. And so I think the reaction of markets to the withdrawal of that liquidity will be different as well.
Okay, thank you. And Rhona, contrary to what Tom was saying, or Tom's forecasts, your forecasts, in fact, of the analysts we surveyed, which were 24 for gold, you came out with the highest on your range, a potential 1510 you could see this year in gold. What do you think could take us there?
Comes back to equities.
Similar argument to Tom's, and so
yes. From a practical standpoint, it's perfectly possible that the change in the corporate tax regime in the United States could continue to underpin further strengthen the equity markets because of the projections for earnings and so on and so forth. But as I alluded to earlier, there is a conflict between the Fed and the government. I'm not sure that I see that playing out terribly comfortably. And at some point, again, coming back to what Tom says, liquidity, once the locomotive, that is the S&P, starts to head towards the sidings, then it could well be that it will be a hard stop, at which point, generally speaking, just because of the way the gold market works, you would probably see a knee-jerk downward reaction as people run for liquidity and to raise cash against margins, although the S&P is now T+2 as opposed to T+3, so that argument has weakened slightly. But that also talks to gold reasserting its role as a safe haven, at which point you could well see money flooding into it. And our high, I must say, is a technical call as opposed to a fundamental one, but if you do start to see covering and people rushing for cover in the other sense, then that could propel us briefly into that kind of spike. Okay, thank you. And in fact, actually, I suppose it leads on generally to what do you think could get institutional investors to return to gold? I think I wouldn't be being controversial. I said that precious metals have not been on too many people's radars lately, certainly not compared to how we were in 2011 when gold hit its peak around 1920 or so. Do you think, under what sort of scenarios do you think we could see the large institutions coming back on gold, or at least diverting their attention to gold from some of the other investments out there? Fear of equities overheating would be my number one candidate for that.
Fair enough. And Tom?
I think it really comes back to me to the debt dynamics of the US. We're going through this period where the debt ceiling is going to be raised again. And in the short term, the administration's tax policy is likely to be supportive of economic activity, business confidence, consumer spending. So that's all positive. But I think longer-term investors look through that. Certainly, I think the ratings agencies will start to look through that. I think there's very little belief that the argument that the tax cuts will be funded by increased economic growth will play out neatly over the next few years. I think even if you accept that argument over the long run, there's always going to be a considerable lag. And so I think for me, it's looking at the trajectory of the U.S. budget, looking at the income that the U.S. is getting from tax receipts, and trying to line that up and see where we think the U.S. is going to be in terms of a AA rated entity.
Okay, thank you. Now, one of the things we haven't talked about and does, I know, excite interest a great number of people investing in precious metals is physical demand. And most of the conversation we've had so far has been far more, particularly in gold, around US policy, and we haven't even got into geopolitics yet, but obviously that can be a major factor. But I wanted to look at physical demand for a moment. And Rhona, perhaps you could tell us your thoughts on what you see developing in India and China in 2018.
A sluggish start for both of them, which is a kickback to what's happened in the last 3-4 months of 2017. For different reasons, the Indian government has been loosening up some of its controls on the market, and that has helped fabricators in particular, and with the result that in the latter part of last year, fabrication demand picked up tremendously. And while private demand picked up also, the increase was nowhere near as high. So there's been quite a lot of fabrication which has now gone into particularly jewellery inventories. So while there is a degree of pent-up demand from the private individual, that's not going to impinge on the international market in any great effect, because the jewellers have already got the material in hand. As far as the Chinese market is concerned, something similar has happened. There was a resurgence in retail interest towards the back end of last year. Fabricators naturally responded, and to most eyes from people on the ground out there, they've probably actually overdone it. So they've come into 2018, they're also carrying inventory. To put some colour behind that, the sentiment amongst Chinese people has been going through some very interesting changes, to the extent that certainly amongst the youngsters, where they are buying jewellery, they're now looking towards carat pieces rather than 4/9s, which reduces the tonnage in the short term, but actually in the longer term, it's supportive for the market because it means it's less likely to come back at scrap because of the price dynamics. Right. There's also the competition for the leisure dollar, of course. So jewellery we are expecting in China to remain under pressure. The other side of the market, which is bars and to a much lesser extent coin out there, is much more a function of sentiment and perception of price action. There is pent-up demand there, but we're not expecting it to come out until A, the price has shown some improvement, and B, the belief has grown that that price action can be sustained, and that belief is not there yet.
Thank you. And Tom, how do you see those markets?
India had a much better 2017 than 2016. Given how poor 2016 was, that wasn't possibly very hard, but it was a significant improvement in that market, certainly from Q2 onwards last year. And I think if we have a year of relative policy stability in the Indian market, then I would be reasonably optimistic. The market there is very mature, but is still evolving and developing. And there are a number of initiatives in the Indian market that I think will be helpful going forwards, particularly the discussions that are ongoing there about creating a domestic spot market. So I'm reasonably optimistic for India this year. Clearly, it's not. I'm not looking for a return to the real heydays of that market of several years ago. But I think another improvement on what we saw in 2017 is certainly plausible. For China, yes, I think I largely concur with Rhona's comments. For me, what's interesting in the Chinese market, it's a very well developed, very sophisticated over-the-counter market there in terms of the physical products and the distribution networks, and all of the trading and supply that goes around that. What I think is interesting for the next phase is the potential to more fully integrate gold into the financial system in China. So the use of gold, for example, on mobile payments platforms. I think China is the place where gold really has a chance to get deeply in the financial system in a way that it hasn't done and probably can't do in many Western developed markets.
Is that because you think, particularly in China, although to some extent in India too, it's, people always talk about it being in the DNA of the population and so on, particularly as both places have it. I was going to say quasi-religious. It's certainly not that in it's traditional gift giving, and you think that is because it's part of people's natural thing is to buy precious metals in both countries.
No, for me, China, it's more because it's been deliberately put into the DNA of the financial system by policymakers.
Right. Okay.
And it's much less about clearly the individual desire to invest in assets and the limited choice of assets within China has clearly been an influence. But I think going forwards, it's continuing this very well-structured, forward-looking strategic policy that the Chinese government and the PBOC have pursued to integrate gold within the financial system with the long-term aim that it contributes to a smooth internationalization of the currency.
Okay, thank you. Rhona, would you have any thoughts on that as well?
Basically, I'm in full agreement with what Tom says on that one. Yeah.
In fact, one of the interesting things, and you were talking about carat jewelry in China. I remember they were trying to bring the population, the younger population, 20 odd years ago with carat jewelry, making it much more fashionable and stuff, and then a whole bit around white gold. But there was a change that slide. There was a piece in the Times last week about platinum guilds and having their marketing campaign, particularly around India, of platinum jewelry for, I can't remember what they called it. It wasn't around a wedding, but it was some point after that, and the impact that it had on fashion. Do you think that maybe is the thing that could potentially rescue platinum, that it's seen we get away increasingly from the industrial to more jewelry demand?
Possible in India. It would take a long time and a lot of hard work. Unlikely in China. There's two comments there. One is that there is something of a natural aversion to white jewelry in favour of yellow. There is also the memory of the way that the Palladium jewelry market rocketed under good marketing, about 10 years ago now, in China. But it never really, to pick up your analogy, it never really got into the Chinese DNA. And then the marketing program stopped, and it's just fallen off a cliff. So that will also remain with people in people's memories. And certainly what we've been seeing is that yellow is definitely the colour of preference. And one thing I would say about caratage, actually, is that there's been a problem over the last 2, maybe 3 years with the colour of the 18-carat alloy in China. Someone somewhere hasn't been doing their job properly, and the colours have been fading. Rather than switching away from 18 towards 14, people who've been put off 18 have actually moved to 22.
Right. Okay. So then you do run the risk of it can come back as scrap much more than once you go back up to 22.
To a point, yeah.
Okay. Well, I'd like to thank you both for the comments today. And one final thing I'm going to ask you before we wrap up this little thing is, from each of you, the one thing you think that people should look out for this year. It can either be a changing thing, a steady thing, but just one thing you would say to people, this is going to be a key event. It could be any of the 4 metals, and it could be around anything. It could be a fresh tax cut, interest rate hikes, or whatever. It's entirely your thing. But just as a final remark from each of you. Tom, do you want to go first?
Yeah, sure. I wouldn't recommend anyone gets fixated on President Trump's Twitter account, but it really is, when you're thinking about the Fed, you're thinking about the dollar, you're thinking about U.S. interest rates, you're thinking about the U.S. economy. Markets are reacting to the perceived change in direction from the top, and I think that's what we focus on, certainly with respect to gold. So that's probably no change there. With Palladium, I think it really is trying to get a feel for above ground inventory, and when you really get to a pinch point, and that, as I say, has the potential to really cause quite a dramatic reaction in the price should we get to that point.
Thank you. And Rhona?
From a geopolitical standpoint, the potential for further deterioration between what we could notionally call East and West, or even West and West, given President Trump's relationship with parts of Europe. From an industrial standpoint, and this would be a longer term rather than an event-driven comment, is the extent to which the evolution of the auto industry goes towards hybridization and electrification, and whether we can trust the governments with whether they're 2025 and 2040 deadlines.
Okay, thank you. One thing I didn't actually ask either of you, and not throwing you under the bus, but cryptocurrencies, and maybe just, I said it was my last thought previously, but I'm going to make this the last thought, because somewhere will have me shot if I don't mention, at least try and mention cryptocurrencies, Bitcoin or whatever.
Bullish for gold.
For gold, other
Yes,
cryptocurrencies, yeah.
So something's going to happen there. I already know people who have positions who can't get out.
They're trying to stop loss or trying to take profit, do you think?
They can't find buyers on the other side.
Yeah, but I mean, they've made money or they've lost money, do you think? 'Cause, I mean, a lot of people are doing profit. Okay, yeah. I suppose that's if you can't get out, that's at least a positive way of not being able to get out.
I suspect the way the cryptocurrencies are going to play out is a few people will make a lot of money and a lot of people will lose a little.
I would think a lot of people lose a lot, actually. So, yeah. Tom?
I don't see cryptocurrencies as a competitor to gold. It's a fascinating part of the financial markets. I think it's here to stay, probably not in its current form, but I think it's more about how the blockchain technology behind that gets applied to the gold market. That for me is the interesting part of it. I suspect that many of the 60+ cryptocurrencies that are already out there will fade very rapidly into history.
Okay, and I shall perhaps finish on one remark, which is that you mentioned blockchain and gold, and of course the LBMA has put out recently a RFP for people to come up with ideas of protecting integrity of the supply chain, which could include blockchain within that. But obviously that's something for the future. But thank you both very much, Rhona O'Connell and Tom Kendall. Thank you both for coming and for joining us.
Thank you, John.